Okay, let's talk about some external hedging method, and I will start with, first of all, FRA, forward rate agreement. FRA, forward rate agreement. So it's one of the traditional approach to hedge your transaction risk. Forward rate agreement. What is that? You fix your rate of exchange with a bank or with a exchange. Like what? Let's say we make a sale transaction, let's say, or we make a purchase transaction in other than our local currency, and we know the settlement is in 6 month time. So we are worried about what will be the exchange rate in 6 month time. So let's fix it. How? We can visit any bank or any exchange and tell them, look, this is the currency. In this currency, on this specific date, this specific amount, I will receive or I have to pay. And we want to translate. Give me a rate today. So exchange will say, okay, don't worry, this is a rate for today. So you make a contract with the exchange and with the bank, and in this contract, you specify everything. What you specify? Currency, dollar, pound, dirham, rupee, yuan, yen, whatever. You need to fix the currency, which currency it is, how much units of this currency, $10,000, $5,000, whatever units, and the time, 6 month time, 3 month time, 4 month time, and rate. Everything you determined, you fixed in this contract. This is called forward rate agreement. What's the benefit for it? Now we need to be relaxed. We don't need to worry about, right? Look, it's very simple. Like if I want to travel to my home country, and I'm checking the prices every day, I'm checking the prices. Prices is up, prices is down. Then I buy the ticket. No, I don't need to worry about where the prices are going up, going down. Same like that, even though you have to pay in future, but you fix this thing with the exchange. Current spot rate to US dollar against UK sterling is this. Look, you have two rates given, and a 1 month forward rate is this. A UK exporter expects to receive $400,000 in 1 month. If forward exchange rate is used, how much will be received in sterling? Okay, so don't use spot rate now. Use forward rate. Simple. Rate is given to you. Idea is same. Okay, idea is same. So how you will use? Okay, so first of all, see, it's a division case or a multiplication case. Okay, we have to translate $400,000. Okay, division case. Okay, we are not going to use spot rate now, right? Don't use spot rate now because we are going to hedge using the forward rate. So take the forward rate. That's it. Again, forward rates are two. Okay, so it's a division case. Here dollar, and here dollar is the first currency. So it's a division case. So we have a payment or receipt. Receive. It's a receipt case. So divide, we will go with the rate that result into lesser receipt. We divide with the higher rate. So the higher rate is, we have two rates. So this is the lower rate and this is the higher rate. So divide with this rate, dollar 1.4565. This will be the receipt you are going to get using your forward rate, and it's fixed. You don't need to worry about after 1 month, whatever the exchange rate will be, you will get this money. So FRA is very easy. Same. So rather than using the spot rate, use the forward rate. Okay, maybe he gave you many forward rate, and let's say your receipt is going to be happen in 6 month time. He gave you 3 month forward, he gave you 9 month forward, he gave you 6 month forward, but you have to use 6-month forward. That's it. Okay, what are the advantages and disadvantages of using the forward rate agreement? Okay, flexible. Advantages: flexible with regard to the amount to be covered. Any amount you can cover. It's up to you. Let's say you expect any specific amount, you can go. Look, as compared to forwarded agreement, what other alternative we have? Currency future. I'm coming to it as well. What is currency future? A currency future is again same a forwarded agreement, but not with a bank. It's with a forex market. But if you want to go with the currency future have a standardized contract. I mean, let's say it's standardized. Let's say, okay, you can make one contract of $80,000 or two of $160 or three of, so you have to make only a standardized contract. So here you have a one flexibility is that you can decide any amount, any dollar, any currency. Okay, currency future is not available in any currency. It's only for major currencies available. Here, because it's specific, it's a one-to-one contract, it's a private contract between you and bank. So you can decide for any date, you can decide for any currency, you can decide for any amount. Okay, so that's the key thing first of all. Relatively straightforward, both to comprehend and to organize. We don't need to worry about, we don't need to do forecasting. So just stick. We know that our budgeting will be more easier, our forecasting will be more easier. We know what we are going to receive after 1 month, after 3 months, after 6 months, because we don't need to worry about any exchange rate fluctuation. Drawback: contractual commitment that must be complete on the due date. Let's say we made a contract with a bank, okay, that we are receiving this 2 billion or $2 million from a customer. What if customer delay the payment for a few days? But you must have to fulfill the contract on the same day. Okay, so chances of default is also exist here. No opportunity to benefit, yeah, favorable movement. No, you fix the rate. It's an agreement. So if exchange rate move favorable side, it's a loss for us, kind of. Now, the second topic that we are going to do today is money market hedge. This is little technical, not straightforward like forwarded agreement. In forwarded agreement, examiner will definitely give you a forward rate. So we simply have to use it. 3 month forward rate, 6 month forward rate, 9 month forward rate, 1 year forward rate, and so on. What is the money market hedge? Look, in money market hedge, we are worrying about that exchange rate might change in the future, right? Exchange rate might move adversely in the future. That's a factor. So in money market hedge, we don't wait to translate in the future, we translate today. It's not a lead payment. No. It's not like a lead payment, but we manage a hedge where we don't have to translate the money in the future. Rather, we will translate today. How? Look, so we have two different types of money market hedging, different for payment and different for receipts. Okay, so first of all, we will learn how to make a hedge for payments. How can you make a hedge for a foreign currency payment in the future? Okay, so let's suppose we are based in UK. Our home currency is pound. And let's say we have to pay $100,000 in 6 months' time. We have to pay $100,000 in 6 months' time. And we are based in UK. Our home currency is pound. Now we are worrying about, because, okay, let's say it's a payment, right? So when times come in 6 month time, let's say if we want to pay straight, then after 6 months we need to go to exchange. We need to provide our pounds, and they will give us the dollars. And if exchange rate move adversely, the issue will be that maybe we have to pay more pounds. It costs us more. To avoid that, what should we do? To avoid that, the way we have to do is we need to arrange dollars today. We need to exchange dollars today. Not exactly $100,000. The present value of $100,000 we need to arrange today. How? By borrowing in pounds. Look, we can borrow money in pounds, convert exactly today into dollars, and deposit into a dollars bank account. After 6 months, when the time comes for the payment, amount will be exactly $100,000, withdraw and pay. This is the money market hedge. Let me recap it again. If you are going to make a money market hedge for payment in foreign currency, arrange this foreign currency today. Let's say you have to pay in 6 month time, right? 100,000 you need to pay in 6 month time. We don't need 100,000 today. What is the rate of interest? Let's say 5%. Okay, discount it using the 5% and find the present value of 100,000. Let's say it's 95,000. Borrow, okay, arrange $95,000 today. Don't you have to borrow, right? But $95,000 you need today. But you will borrow in pounds. Today exchange rate, you know, right? Exactly what's the spot rate. Accordingly, reverse it and see how much pound you needed. Borrow it, convert immediately into dollars, and deposit into a dollar bank account. After 6 months, it will be exactly equal to 100,000. Withdraw and pay. So in this case, do you have to exchange the currency in 6 month time? No. You don't have to wait for 6 months. You exchange the currency today, and you're not exposed to any exchange rate risk at all. Now let's practice it with the help of an example. Yes, of course we have to pay interest, but we will receive interest as well. You borrow in pounds. Yeah, you borrow in pounds, you deposit in dollars. You pay interest, of course, in pounds. You receive interest on dollars, right? Okay, so whenever you're going to make a money market hedge, for payments. Okay, so where we have to start with. Look, we will focus on two things. What is now, and what is the, let's say here, Thakur Co, a UK company, must make a payment of US dollar 450,000 in 3 months time. So you have to pay $450,000 in 3 months time. The company treasurer, finance department, treasury department, has determined the following: spot rate today, 3 month forward rate, 6 month forward rate. Look, forward rate, they always give us for confusion. In money market hedge, we never use forward rate at all. In money market hedge, we transfer the exchange, we will make the exchange or we will convert the currency into foreign currency today, even whether it's a receipt case or a payment case. Right now we're discussing the payment case. Okay, so look, what is the hedging approach? Okay, so just keep in mind, always make a sketch and figure out two things. What is your home currency, or what is your first currency, second currency? Okay, you need to understand. HC stand for home currency here, and what is your foreign currency, right? Determine it, right? Look, in this case, you're a UK company, right? So pound is your home currency, right? And dollar is your foreign currency. First, we determine these two things. Why? I'm explaining it to you. Okay, so we have to pay 450,000 US dollar in 3 months time. What hedge we explain it to you? We discuss, okay, if you have to pay $450,000 in 3 months time, don't wait for 3 months time. Exchange $450,000 today. How? Borrowing in your local currency, which is sterling, right here. So always remember, in payment case, we always borrow in our home currency and then we deposit in our foreign currency. Always. We always borrow in our home currency and then we deposit in our foreign currency. That's always the case. So we need the borrowing rate of pound and we need the deposit rate of dollars. That's why I write this here. Okay, now here, today and 3 months time. I will write here 3 months. Okay, and I will write both the currencies here. We have two currencies. We have, okay, our home currency is pound. So I'm writing here pound and writing here dollar. Okay, so basically our payment is in 3 months time. How much payment we have to make? $450,000. So we have to pay $450,000 in 3 month time. I will just write the numbers here. I have to pay $450,000 in 3 months time. So this is the dollar. Which rate of dollar we have to use? See, deposit rate. Examiner will confuse you with both the rate. Look, for dollar, we need which rate? We need the deposit rate or lending rate. So deposit rate for dollar is 5%. This is the annual rate. We need how many month of rate? 3 month of rate. Okay, so what is the 3 month of rate? So 5% into 3 by 12. What you will get? 1.25%. 1.25%. That means, look, this is a deposit rate. I mean, if we have dollars today and we want to deposit for 3 months, the bank will give me this return. So, okay, if I know the future value, can I find the present value today? If this is the rate of interest that banks will give me, right? We know that. So how should I do it? Discount, right? So this divided by 1 plus interest rate, 1 plus R. Okay, 1 plus 1.25%. If I remove the percentage sign, I have to divide by 100. So 1.0125. That means if we have $444,450 today, and we deposit at this rate with the bank for 3 months, after 3 month bank will give me this. You can find it out. Okay, this multiply with this percentage and add into it, you will get same answer. At this multiply by 1.0125, you will get this answer. So that means we need this money. We need this money today. Okay. If we have this money today and we deposit at this rate, after 3 months, we will get exactly 450,000. We withdraw and we pay. Right? Now, this money we need in pounds. And we need spot rate. Spot rate is given to us here. Which rate we will choose? Adverse. Of course, again, same rule. It's a payment. It's a payment, right? This is a payment. Division case, use the rate, divide with the rate that result into more payment. So we will divide with a lower rate. We need to increase the payment, right? So what's the lower rate? 1.7000. So we will discount using the rate 1.7000 dollars over pound. Is it? Yes. So we will get this money in 2 days time. Okay, we will get this money in 2 days time. How? This divided by 1.7000. That's the answer. That means if you make a money market hedge today, how much it cost you? 261,437.38 pounds in total. It will cost you today. One kind of question where examiner asks you, okay, using the money market hedge, tell me how much we have to pay in our local currency. So this much we have to pay in our local currency. You will borrow 261,437 pound today. You will convert into this much dollars today using an exchange rate of 1.700 and deposit into a dollars bank account. After 3 months, at this interest rate, this amount will be exactly equal to the amount that you have to pay to the foreign supplier. Withdraw and pay. That's it. That's the hedge. Yes. 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 So if you want to see how much you pay in 3 months time, how much it look, it costs only this in 2 days time. But if you want to find cost in 3 month time, yes, you can also find how. Look, in 3 months time, yes, you also have to pay interest. Okay, so write down the rate here. Okay, you will deposit at 1.25%, but you borrow the pound at what rate? What's the pound borrowing rate? The sterling borrowing rate is 7.5%. Okay, fine, in 3 months time. So 7.5% multiply by 3 by 12. So 1 I think 875%. That means on this, you have to pay this much interest, right? The money that you borrow, you have to pay 1.875% you have to pay interest on it. Okay, so if you have to pay this much interest on it, this is the present value. Now we have to find the future value. So multiply by 1.01875, compounding, right? That's what. So basically, this is the actual cost in 3 months' time with interest amount. This is without interest amount in 2 days' time. This is the amount in 3 months' time. So, okay, examiner will ask you, maybe he will ask you to, he can ask you three type of question. Right now I'm discussing the one type of question. He will say, okay, how much it costs today? So cost today is this. How much it costs today? If you make a money market hedge, how much it costs today? And then he will say, okay, tell me which one is cheaper. Money market hedge is cheaper or forwarded agreement is cheaper? See which one is cheaper. A third kind of question he will ask you, tell me what is the effective exchange rate. Effective exchange rate. Can you find out? Yes, look, we need an exchange rate with dollars as a nominator and pound as a denominator, right? So take dollars above and pounds down and find a effective rate. That is the rate that you bound. Look, your rate is not bound at this. You fix your rate at this. You don't need to worry about anything else. You fix your rate at this. Right? You don't need to go to any bank at all. Right? You're doing it internally somehow. Right? You're managing it internally. Right? By using and your rate of exchange is fixed internally at 1.6895. You don't have to pay any extra cost because you exchange it today. He might ask you to find this thing. Right? It's clear? Okay, let's do another question. A company whose local currency is dollar, I mean you are based in US, owes a Danish supplier 3.5 million kroners, which is payable in 3 months' time. You have to pay kroners in 3 months' time. The spot exchange rate is given. We have two rates given. The company can borrow in dollars for 3 months per annum and can deposit kroners for 3 months at this. So look how you have to make this hedge. This is just a shape I create just to explain you, right? So let me explain it and then you can do in your way. Look, which two currencies we have? We have dollar and we have kroners. So dollar is our home currency. Let's say I put dollar here and I put kroners here. Okay. So now, and we have to make a payment in 3 months' time. We have to pay 3.5 million of kroners in 3 months' time. Okay, 3.5 million of kroners in. So this is kroners and this is 3 month time and this is kroners. So the thing will come here. Okay, so within 3 months' time, we have to pay 3.5 million kroner. I will write down here 350. Okay, that much kroners we have to pay in 3 months' time. So how you can make a money market? Okay, so what should we do? We need 3.5 million kroners in 3 month time for a payment. What if we create a kroner bank account and deposit some funds in it today, now, today, here? Not exactly 3.5 million, little less than 3.5 million, considering the rate of interest, right? So if you deposit this in a Kronos bank account, after 3 months, it might be exactly 3.5 million. When times comes after 3 months, the funds within your Kronos bank account will be exactly 3.5 million. Withdraw and pay. That is the money market hedge. Okay. So you need 3.5 million kroners, but not now, in future. So arrange kronas today, deposit into a kronas bank account. After 3 months, this amount, the principal amount that you deposit into kronas bank account plus interest must be exactly equal to 3.5 million. When time comes for payment, withdraw the money from this kronas bank account and pay your loan. But how much kronas we need today? So the question will give us what is the deposit rate of kronas is given. The deposit rate of kronas is 4.92%. So always remember, when a question comes for money market hedge for payment, you have to deposit into your foreign currency. Look here, I got deposit, and here I will write my foreign currency are krona. So I need the kroner deposit rate, which is given to me 4.92% per annum. Okay, it is 4.92%. But the problem is this is per annum. I only have to deposit for 3 months. Okay, so convert it into 3 months. So I need to multiply this with 3 by 12. This is the annual rate. This is not a monthly rate. This is the annual rate. So to convert it into 3 months, I will divide by 4. And I will multiply by 3 divided by 12 because this is the annual rate. So multiply by 3 by 12, 1.23%. That is the deposit rate I have for kronas. That is the deposit rate I have for kronas. Okay, let me see. Is it the same we did? Okay, we will check it later. Okay, then, okay, that means this is the rate I will get. This is the rate I will get here. This is the rate of interest. This is the rate of interest. Yeah, we will get 1.23%. So considering that if I need 3.5 million after 3 years, and if I need a money today, and if I invest at this rate, how much funds I need today? So I need to do discounting, present value, conversion. So how should I do this? This divided by the rate 1 plus R. Okay. So what is the rate? 1.23%. So 1 plus R mean 1.0123. That means we need this much kronas today. I mean, if we have this kronas today and we deposit at this rate to a kronas bank account, after 3 months, it will be exactly equal to this. We can prove it. This multiply with this much percentage, whatever amount add into it, you will get this answer. Or this, simply multiply this with 101.23%. You will get exactly this answer. Let me try this. So this, if I multiply this with 101.23%, it's exactly the same answer I'm going to get. So I'm doing compounding now. This is compounding. When I move this, this is discounting. Is it clear, Arif?
Yes, sir.
So always remember, when I am making a money market hedge or a payment in foreign currency, we have to make a deposit into kronas bank account now mean today. So that much kronas we need. At this rate, we will deposit into a kronas bank account. After 3 months, this will become 3.5 million. But question is how we will arrange this today. So the idea is you will borrow in your home currency now. You will borrow into your home currency now and convert into kronas today. In money market hedge, we always do conversion today. So what is the rate of exchange today? This is the exchange rate today. Okay. So which one we have to use to convert this kronas into local currency? Same idea. Look, it's a receipt or payment. This is a payment. Okay, so we need a rate that is going to increase my payment. Okay, it's a division case or multiplication case. Look, the first currency is kroners, kroner per $1. So we have a division case and we have a payment. We need to divide with the lower rate to increase my payment. So lower rate is first one, 7.5509. So I will use this rate, 7.5509. This is the rate. Using this rate, kroners over dollar, I will convert in today's currency. So how? This divided by 7.5509. So that is my hedge and my hedge is ready. Now how to explain it? I will borrow $457,888 today in my local currency, and immediately I will convert into kroners and deposit it into a kroner bank account. When time comes, after 3 months, this 3.45 million kroners will exactly equal to 3.5 million kroners that we have to pay. Try and pay. That's the hedge. Check the answer. Yeah, so 457,889. Yeah, exactly the same answer we have. So in this case, we have to borrow today. And we have to borrow in which currency? In our currency. So always remember, in a money market hedge for payment, you are going to borrow in your local currency and then you have to deposit in your foreign currency. One more thing, you borrow that much dollars. You borrow that much dollar. Okay, of course, it's not for free. You also have to pay interest on this dollar, and the dollar rate is also given 8.6%. This is a dollar rate, 8.6%. Again, it's annual rate, so I have to find 3-month rate. So 8.6%. This is the annual rate. I need 3-month rate. So multiply by 3 over 12 or divide by 4, 2.15%. That means the loan that I borrow, this loan that I borrow, I have to pay 2.15% interest on this as well, my cost. So if I include that much interest, I have to repay the loan in my local currency as well. So with interest, how much I have to pay back? So okay, let's work out. That's the money we borrow today. I have to add this. I mean, I need to do compounding. Compounding means 102.15%. Okay, or 1 plus R. Simple. 102.15%. If I don't want to put percentage, so 1.0215. Same thing. That means this loan that I have taken today, using this much interest rate, now after 3 months, I have to pay this much loan back to the bank. So can I find the effective, basically in money market hedge, I haven't make a commitment with the bank, but I lock my rate. I lock my exchange rate. How? Can I find the lock-in rate? Yes. I need rate in kroners as a nominator currency and dollar as a denominator currency. So I can find out how. This is kroner, this is dollar. This is kroner in 3-month time. This is dollar in 3-month time. So can I find it? Yes, I can find it. How? This divided by this. My rate is locked at 7.4828. I don't need to worry. My rate is locked at this amount, kroner over dollar. This will be your effective exchange rate, your net exchange rate. So he might ask you, tell me what is the effective cost? What is the effective exchange rate? What's the effective exchange rate for this company? So we would say it's 7.4829. We lock our rate at this amount because Do we have to exchange any currency in 3 months' time? No, we don't have to exchange. We exchange it today. In money market hedge, whatever exchange we needed, we did it today. So we don't need to exchange it in the future. So what kind of question you might get in the exam? He might ask you, okay, tell me how much it cost us today in our local currency. That much cost us today in our local currency. He might ask me, okay, tell me what is the effective exchange rate for us? This is the effective exchange rate for us. Is it clear?
Yes, sir.
This is to make a money market hedge for payments. Okay, steps we need to understand. First, okay, theoretically, we will borrow this money today, we convert into foreign currency today, and we deposit into a foreign bank account today at this rate. After 3 months, we will get this money, we will withdraw, and we will pay to supplier. And whatever loan we borrowed with this much interest, it is equal to this, pay the loan back. That is the money market hedge for payments. If you understand it, then let's try another question for it. Yeah, this question. Can we try that? So look, in money market hedge for payment, look, we are still discussing for payment. We haven't discussed for receipt so far. If you are making a money market hedge for payment, we should borrow in local currency, then we convert into foreign currency immediately and deposit into a foreign currency bank account. After 3 months, the money will be equal to whatever we have to pay, withdraw and pay. So in this case, always remember, examiner will confuse us by giving a lot of exchange, a lot of rates, and maybe he will give you spot rate, forward rate. We are not going to use forward rate in money market hedge. In money market hedge, we only use spot rate. By the way, here he gives us only spot rate. Maybe possibly to trick you, they will give you the examiner will give you the forward rate as well. So don't use it. Forward rate is only for forward contract. You know, we should borrow in home currency. So what is my country dollar cost of? So basically, we are based in US. So we will borrow in US. So we will use the borrowing rate of US, and then we deposit into country P bank account, which is the deposit rate of country P. This is the yearly, so we need to consider that. When we have to pay 3 months time. Okay, let me do it. Let me do it. Okay, so we have two currencies, dollars, and the second currency is one currency is okay. One country P currency, is no mention. Peso, yes, peso. So dollar and peso. So always pick the rate first. So it's a payment. So we will borrow in local currency, which is mean we borrow in dollar and we deposit in peso account. So find the borrowing rate of dollar, which is this 5.59% per year. So 5.59 divided by 12 multiplied by 3 or divided by 4. My God. Percent. 1.4%. And then we deposit into peso account. So peso deposit is 5.31. So 5.31 percentage divided by 4, 1.33%. Okay, how much peso we have to pay? 1 million peso in 3 months' time. Okay, what is the peso rate? is a peso rate. Convert into present value. This divided by 101.33%. Sorry, percent. Okay, let's continue. 3275%. Okay, so that much peso we need. If we deposit at this rate after 3 months, it will be equal to 1 million peso. Now find the currency today. What is the exchange rate today? This exchange rate again is a payment. Division case payment. We use lower rate to increase our payment. 1.6912. 1.9612. Sorry. 1.612. Peso dollar. So convert it. Nine six one two. Okay, so that is my cost today. Okay, after 3 months, okay, I borrow this much money today in my local currency. I deposit, I convert immediately into peso today, and deposit into a peso account today. For after 3 months, this will be equal to this plus this much interest will be equal to 1 million. I withdraw and I pay my funds. I pay my to my supplier. And after 3 months, because I borrow this fund, so using my currency interest rate, this amount will be equal to, I have to compound it, to multiply by 101.4%. That much bank loan I have to pay back, including the interest. So my effective rate, my effective exchange rate is peso over krona. This is my peso divided by this is my dollar. 1 point. I fix my rate. I fix my exchange rate at 1.9598. That's the answer for it. Now, let's talk about the money market hedge for a receipt. It's similar, but little opposite. Look, now let's say we are expecting a receipt. We are expecting 1 million pesos in 3 months' time from a foreign customer. And we are worrying about again the exchange rate. Now, what we know, okay, we are receiving 1 million peso. So we will borrow in peso so that after 3 months, when we receive the peso, we will pay the loan. We are receiving 1 million peso. So borrow today the present value of the pesos today, convert into your home currency today, and deposit into the home currency bank account. Because you borrow in the foreign currency in pesos, you borrow the present value of the pesos only. After 3 months, this will be exactly equal to the money that you're expecting to receive. Right? When you receive, pay the loan and withdraw money that you deposit into local bank account. How it works? Working is exactly the same. Just we need to change the rate of interest. That's it. So in case of receipt, you will borrow in your foreign currency and then you deposit in your home currency. Again, 3 month time, we have to make a money market hedge. So calculate the receipt from 1 million peso sale due to the received in the 3 month time if money market hedge is used. So once again, we have to receive 1 million peso. It's a receipt now, not payment, in 3 months time. So idea is, now what's the idea now? In case of payment, what's the idea? We have to pay. So deposit into the foreign bank account so that when time comes, withdraw and pay. Now you have a receipt. So the idea is borrow in peso. So after 3 months, whatever you receive, pay the loan. Opposite. So look, we should borrow in peso today, not entirely 1 million, little less than peso, little less than this, so that after 3 months, with the interest, this loan will exactly reach at 1 million. After 3 months, once we receive 1 million, pay back the loan. That's it. So we will borrow in foreign currency, and then the whatever amount we kept, deposit into your home currency. Look, so what should you do? So in case of receipt, you have to use the borrowing rate of foreign currency because you will borrow in peso now. You will borrow in peso now, and then you deposit in dollars today. Today, these all things you will do today. You will convert into currency today, right? You don't need to wait for 6 months, 3 months time. So first of all, let's find out the peso borrowing rate. The peso borrowing rate is, I think, this one. It's opposite. In case of payment, we use this rate. No, we're using this rate. And then you deposit in dollars. So we will use depositing rate for dollar. Okay, now 5.38%, 5.38% for peso, 5.38%, 5.38% divided by 4. We need 3 months only, right? 1.35%. So we borrow in peso at this rate. And then we dip 1.3450. Okay, that's the answer. Then the deposit rate for dollar is 5.50. So 5.50% divided by 4, 1.38%. So that is the rate we are to use for dollar. Okay, now what's the idea? We should borrow in peso today. How much? Let's find the present value of this peso today. Same, calculation is same, but logic, yeah, is very important. So this divided by 101.3450%, mean we are doing discounting, converting into present value. So that is the bank loan of peso we will borrow today. After 3 months, with the interest cost, it will exactly equal to 1 million. When I receive from customer 1 million peso, I have 1 million of 1 peso loan. I receive and I pay my loan back. That's it. The question is what we should do the peso. How look, this is a peso we borrow, right? This is a peso that we borrow. Okay. What we should do with that? We will convert it immediately in our home currency using my current exchange rate. So what is my exchange rate today? This is my exchange rate today. Now it's a case of receipt. Receipt mean we need to lower the receipt. Division case, we will use a higher rate, 1.9618. 1.9618 at 1.9618 peso over dollar. I will convert it today. Division case 1.9618. So I will borrow this much pounds, this much peso today. I will convert into dollars today and deposit into a dollar bank account today. So this is the income I will get after 3 months, whatever I deposited plus this interest income. How much it will be total? I will do compounding. So 101.38%. So what is my receipt, by the way? This is my receipt total in today's term. Okay. So he might give me a question. Okay, tell me what is my net receipt today? Okay, my net receipt today is $502,971. And then he might ask, what is the receipt using the FRA? You will calculate. And tell me which one is best. The one which is highest. Look, it's a receipt. Receipt means highest the better. Payment means lowest the better. So which one is higher? We will go for it. Second question. He might ask, okay, what is my effective exchange rate? We can find. Okay, so this much money we borrow today, we convert today into my local currency and deposit into a local bank account. After 3 months, it will be exactly this. The loan that I borrow in peso with this much interest, it will become 1 million. So when money received, we pay off our loan, and whatever funds we deposit, we withdraw it. What is my exchange rate? What is my effective exchange rate? Same. So we fix or we lock our exchange rate at this amount. We don't need to worry about our rate is locked at this amount. This is the money market hedge for a receipt. Okay, now we're expecting a receipt of 1.2 million in 6 month time and also have a payment of 300,000 in 6 month time. So when he gave you both receipt and payment, you have to match it. Even he don't mention it. Logically, we know we need to match it. I mean, we will receive 1.2 million and we have to pay 300,000. That means effectively, if you look at, we have to pay a net receipt of 900,000. We only have to hedge this 900,000. Okay, so how much we have to hedge? 900,000. We're expecting a receipt of 900,000. Which currency it is? Dollar. And our home currency is pound. We are receiving $900,000 in 3 months' time. No, it's a receive. It's income, right? Our risk is maybe we receive less money, less income in pounds when we convert after 3 months' time. Sorry, 6 month time here. 900,000. Okay, now, first of all, keep the rates first here. So we need $900,000. We will receive in 6 month time. So we will borrow 900,000, not the $900,000, the present value of $900,000 today, and we exchange into home currency today. When times comes after 6 months, the money that we borrow plus interest will be exactly equal to 900,000 that we have to pay. The money we receive, we use for the payment. That's it. Okay, so what is the, first of all, dollar is my, okay, pound again is my home currency. Pound is my home currency and dollar is my foreign currency. Okay, so use the pound deposit rate. The pound deposit rate is 6%, and we need 6 months into 6 by 12, right? So it will be, I think, 3%. And use the borrowing rate of the dollar. The borrowing rate of dollar is 6.5% into 6 by 12. So I think you will get 3.25%. 3.25%. Okay. So just use it. Okay. So this is the dollars. Use the dollar rate, which is 3.25% to discount it to today's value into 3.25%. What value you will get today? 900,000 divided by 1.0325. That means the present value of 900,000 is 871,670. So we will borrow this money today and using the exchange rate. Which is the exchange rate we will use? Which rate we will use? 3 months, 6 months, or spot? Spot. In money market, we always have to use the spot rate. Which rate we will use? It's a receipt. Division case. Higher rate, 1.7040. Right? Dollars over pounds. What payment you have to make? 1.700. That is cost to you in 2 days time. If you want to find in 3 months time, you can find. Just compound it with the pound rate, which is 3%. 3%. So compounded 1.03. Right? No, this is not a payment. This is a receipt, right? If he asks you to tell me which one is better, so no, it's a receipt, right? You will go, I mean, let's say he said, okay, first of all, what will be the receipt using the money market hedge? What will be the receipt using the forward rate agreement, right? And what is the best of them? Let's say here we already have 6-month payment, right? We already have a 6-month forward rate, right? Let's say we want to find the forward rate agreement as well. Okay, so what receipt you will get? Can you find? And I want to compare which one is better for me. I want to compare which one is better for me. Okay, so what is the 3-month receipt using the money market hedge? This. Can you find the 3-month receipt using the forward rate agreement? What amount you will get? Simple. Uses 6 months, not 3 months, right? 6 months. What is the 6-month forward rate? Use the same ruling. So receipt, division case, use the rate that result into less receipt. Is it? So we use the higher rate, right? 1.6809. How much you will get? How much payment? 900,000. Receipt 900,000 divided by 1.6809. Which one is better? Forward rate agreement is better because it's going to get the best receipt. There's a money market. Don't compare FRA with the present value. Why? Because FRA is the future value. Always comparison of FRA will be made with the future value of the money market hedge. Keep in mind, don't make a mistake. Okay, so from this, the higher receipt you will get with the FRA. So FRA is your choice. By the way, the difference will be very small. Let's do this question, mini case. This is a similar question we have in the past exam paper as well. What is the value of dollar of the receipt? Look, yeah, okay. So you have some receipt in 3 months time, then you have some payments in 6-month time, then you have some receipt in 9-month time. We can't do matching here, right? We can't do matching here. If any of it coming at the same timeline, we can match. Since it's the receipt, he's talking about 3-month receipt. That means he's talking about the first one, right? This one. So you're receiving 197,000 pesos. We are using forward rate. So 3-month forward rate is this, right? Yeah. So forward rate, look, forward rate agreement is very simple, very easy. The forward rate will be given to you. Just use it. So now, since it's the receipt division case, we'll use lesser receipts. Reverse case, we will divide with the higher rate. Is it? So the answer will be 197,000 pesos divided with 1.9612. Which answer you will get? D is the answer for it. Next, what is the value of the dollars of the payment in 6 months if a money market hedge is used? First of all, make the money market hedge for the payment. Payment is, we will, yeah, so it's a payment. It's a payment. So we will borrow in home currency and then deposit into the foreign currency. When times comes, we remove the money from deposit and we pay off. Okay, so keep in mind what we have to do here. Should I solve it? Okay, so we have to pay pesos of 293,000 pesos. 293,000 pesos. Okay, first of all, find these rates. Dollar borrowing rate, dollar borrowing rate, dollar borrowing rate, 5.59%. This is the annual one into 6 by 12. 5.59%. 5.59 divided by 2. You can do this. 2.795%. And peso deposit rate, lending rate, 5.31. I mean the country P deposit rate, 5.31. So 5.31% divided by 2, or 6 by 12. Same answer you get, 2.655%. So since peso, we will discount using the peso discount rate, which is 2.655. What answer you will get? 1.02655. 285,422. What mistake you made, Sumina? Maybe I made a mistake. No, this is a peso, right? So look, that's why I always recommend you to write this on the front, so that when you're choosing the rate, you will not make a mistake. So in payment, you always borrow in home currency and you always deposit in foreign currency. In receipt case, opposite. So that is peso you need today. If you have this much peso and you deposit at this rate for 6 months, after 6 months, you will be exactly getting 293,000. This is your deposit, withdraw and pay. When times comes, withdraw and pay. Okay, but this much pesos we need. We borrow in home currency and we convert into pesos today. So how much dollars we need today? We will use the 2 days dollar rate, spot dollars rate, which is this. It's a payment. Division case, divide with the lower rate to get the higher payment. 1.6912. 1.6912. Yeah, 1.9612, sorry. 1.9612 peso over dollar. $1.9612. Okay. So that is the payment. In 2 days' time, what he said in 2 days' time? What is the value of dollar in 6 months? Not 2 days' time. In 6 months, if money market hedge is used. So 6 months mean we need to find this number, right? So how? What is the rate of interest? Look, this is the money you borrow. Then you using this exchange rate, you deposit at this rate. You convert in. Okay, sorry. Once again, you will borrow this much money today in dollars. Using this rate, you will exchange into pesos today and deposit at this rate for 6 months into a peso deposit bank account. After 6 months, it will be exactly equal to 293,000. You will withdraw and you will pay off your money. With the money that you borrow, with this much interest, after 6 months, you have to pay how much? 2.795% you have to pay on it. So this times 1.02795. This is the answer, 1414602. That's the answer. C is the answer. Okay. Next, what is the value of dollars of the payment in 6 months? Same if the forward contract is used. If you use a forward contract, the same answer for the same question, how much you have to pay? It's a payment, and we need to increase the payment, so we will go with the lower rate again, 1.9585. 1.9585. So if we are going to use the FRA, okay, very simple, 293,000 divided by FRA, 1.9585. Okay, so we're done with the both the calculation that we're expecting in the exam. These are the only two calculations you're expecting in the exam: forward rate agreement and the money market hedge. That's it. Next, we have foreign currency derivatives. And in foreign currency derivatives, we will talk about these three things, which is left: currency future, currency options, and currency swaps. Okay, what is currency future? Currency future is similar to forward rate agreement. Similar. It's a contract. Just like forward rate agreement is a contract, currency future is also a contract. Difference is forward rate agreement you made with a local bank, maybe. It's a one-to-one contract between you and the bank. But currency future is a contract between you and the forex market. Right? You have forex market also. So it's a market, big platform. So you can also make the contract with the forex market as well. Okay. So forwarded agreement and currency future is the same. So the one mean FRA, as we discussed before, it's an agreement you made with just one bank. But currency future is an agreement you made with the forex exchange. What's the difference between these two? We have to understand this. The good thing is this topic are not going to test it numerically in your exam. Okay, examiner specifically mentioned in your study guide, if you read it, that these topics will only be tested theoretically only. So you need to understand the concepts behind these topics. You don't need to go in detail. Your detail will be tested in your advanced financial management paper. Okay. So what is the difference, the main difference between these two things? Okay. Currency future and the forward contract or forward rate agreement. The difference is one is the private contract, or we call it over the counter contract, or we call it tailored contract. Look, it's tailored to your requirement. For my requirement, I go to the bank. I tell them, okay, I am going to hedge using FRA this amount in that much time, right? So give me the rate. So the FRA, the forward rate agreement or the forward contract, is a private contract between you and the bank. But the currency future is a contract between you and the forex exchange. What is the difference? Let's try to understand this. Number one, as I said, since forward contract is a tailored contract, tailored to your requirement, so it is for any currency, any amount, and it have any settlement date possible, right? So let's say we're expecting to receive, let's say we're expecting to receive 100,000 Canadian dollar on 18th of March, let's say. So we will go to a bank and possibly we hedge it using the FRA. But since the currency future is exchange traded, it is not available any date. So it has only 4 maturity dates available, right? Which is end of March, end of June, end of September, end of December. So mean you can only buy 4 types of the contract, the currency future contract that is going to mature, that is going to end on 31st March, 31st June, 31st September, and 31st December. Okay, number one. Number two, this contract is available in any amount, but this is not available in any amount. This is a standardized contract size. I mean, let's say we are receiving euros in future and we want to hedge using the currency future. So currency forex market says, okay, we have contract thing. So if you want to buy one future, it's a standard of 12,500. If you want to buy two contract, 12,500 into 2, 25,000. I mean, let's say we want to hedge 26,000. We cannot hedge for 26,000. We can only hedge for 25,000 possibly. Our 4 contract, 50,000. 8 contract, $100,000. You got my point, Napura? So the thing is, here you cannot, sometime it's not possible for you to hedge the perfect amount. Let's say you are going to receive 60,000 euros. You're going to receive 60,000 euros. So 12,500, I think, into 4. So you can buy maximum 50,000 or 5, which is, I think, more than 62,000 something. So you cannot exactly match the requirement sometime in this case, number one. So this is available in any amount, but here we have a standardized contract. Number two, it is available in any currency, but this is only available in major currencies like yuan, dollar, pound, and these. And keep in mind, in currency future, your second currency is always dollar. The currency which is denominated in one term is always dollar. Okay, so that's the key differences between these two. The question is, if you have the private over the counter option available using the FRA, then why you need to go for the currency future? Maybe currency future is more beneficial for you. Sorry? Higher risk in the forward contract. Yeah, in forward contract case, because there's no security provided to the bank. So individual can default, right? So let's say I have a contract, I made a contract, FRA contract with the bank, that okay, I will exchange this currency with you in 6 months time. Unluckily, I'm not able to get that foreign currency in 6 months time, right? For example, so I'm not successfully, I failed to meet the requirement of the FRA. But here, in case of currency future, there's no default risk. Why? Because look, for currency future, you have to make an account with the forex market. Okay, when you make an account, you need to deposit some initial margin amount, right? So this initial margin amount you must need to maintain. Okay, there's an initial margin, when you make the contract, if it's a loss, it will be deducted from your margin account. And there's a variation margin. When your amount fall below that margin, you need to deposit further amount to make a further transaction with the forex market. Little complicated, but I will try to make it easier for you. Just try to understand what I'm trying to say. Just focus on me. Okay, so whatever what what I yeah.
Future, sensitive date are more used than the December.
Yeah.
But in forex market, it's anytime. Like you can do it anytime.
Yeah, you can fix any date, right? But in currency future, you have one more extra advantage available. What? Yes, you have contract ending date in end of March, end of June, but you can close the contract any time before. Let me explain you with the help of the example. Okay, I will try to explain it to you with the help of an example, and then I will come back to you with this idea. By the way, it is clearly mentioned in the exam that your calculation is not going to be tested in your exam. But for the purpose of understanding, let us do this question. No, it is currently February, and a US exporter expects to receive 500,000 pounds in June. Okay, you're expecting to receive 500,000 pounds in June. In the Chicago market, the pounds standard size rate is 62,500. Right? I mean, one contract for the currency future is 62,500. So, okay, you are going to receive how much pounds? 500,000. So, 500,000 divided by 62,500. So, that means how much contract you might be able to find. See, it is exactly coming or not? By the way, it is an easier question. So, I think it should coming exact amount. So 500,000 divided by 62,500. Yeah, it's 8 contracts. Okay, so to hedge this using the currency future, we will go to exchange today and we will buy 8 contracts. Okay, if it's a receipt case, we will sell 8 contracts. It's the payment case, we will buy 8 contracts for your understanding. By the way, this is a hypothetical contract with the exchange that we will sell currency to you. We are not going to sell currency to the exchange. We are just going to offset the gain and loss with the exchange. Now, which contract you have to buy? As I said, we have 4 contracts available. We can buy the March contract, we can buy the June contract. So, which contract we are going to buy? We are going to buy the contract which is expiring immediately after the settlement date. Okay, what is our settlement date here? June. So we will go with the June contract. Keep in mind. Okay, I mean, let's say your settlement date is, right now we are on 9th February. Let's say our settlement date is 28th of February. So what is the expiry immediately after March? We will go with the March contract. If our settlement is 8th of August, we will go with the September contract. Immediately after 8 August is September contract. If our settlement is on 28th of December, December contract. So first of all, we will choose the contract which is expiring immediately after the settlement date. Okay, so here we will go with the June contract, and look, he mentioned the June contract. June contract, if we go with it, the price is 1.65. Okay, so that means, look, so first of all, we will go with 8 contracts. Okay, and we will hedge according to that. So with the 8 contract, okay, we will hedge this amount, uh, and we will fix our rate at 1.65. We will fix our rate at 1.65. So what that mean? We have to wait till 30th June? No. We can close any time before. 30th June is the last date. You can close the contract. How you can close the contract? By taking the opposite position. Let's say you buy future here, right? And your settlement date is, let's say, 15th of June. So on 15th of June, whatever the price, you will do the opposite position, sell contract. If you buy future now, you can take the opposite position, sell future. So whenever you take the opposite position, contract will be closed. And the difference, whatever gain and loss, it will become into your bank account, into your account. But if you don't close till 31st of Jan, it will be automatically closed on 31st Jan. So that means it is more flexible. In FRA, you have a fixed date. If you fail to meet the payment on same date, if you fail to receive the same amount on the same day, the chances of default is there. But here, maybe one day up, one day down, you still have flexibility till 31st Jan here. Got the point? So right now, because it's a receipt, when we have a receipt, we will sell future. When we have a payment, we will buy future. Simple. When we have payment, we will buy. When we have receipt, we will sell. So, okay, right now we will sell at the current rate, which is 1.65. The settlement date, whatever the rate, you will take the opposite position. Okay, I take the opposite position. So rate is 1.70. So I sell at 1.65, mean I sell at cheaper rate, I buy at higher rate. That is my loss. But this is a loss per contract. Okay, I multiply with my contract, how much contracts I have, 8 contracts, and multiply with the contract size. So that is my total loss I made using this currency future. Now the question is, if I make a loss, why I enter into this contract? If I make a loss here, definitely we make a gain by selling the currency in the forex, in the actual market, in the open market. So let me summarize this. Basically, currency future is a bet. Look, we were receiving dollars. What was the worrying factor for me? That currency might depreciate. So we will bet in the currency future that this will depreciate. If it's depreciate, so you win the bet. You will get the gain from there and you will lose the money from there. Both will offset on both sides. Look, so your loss is 25,000, but see, what is the exchange rate on that day? 1.7. So you can sell the currency in the open market at 1.7. And how much benefit you are going to get? See, you will sell the currency at 1.7, and how much benefit you will get? So your increase in the value will be exactly equal to the loss you made in the bet. Both will offset each other and you will be in the net position. So that means effectively you lock your rate. Okay, so what is the currency future? It is same like FRA, but this is with the forex market. Okay, the benefit of this is we have no chance of default. Number one benefit. Number two benefit, we can close the contract any time before the expiry of the contract. So more flexibility available here, and it may be more beneficial to you than the forward FRA contract. Or even it may be more suitable than the money market hedge, right? So we might go with that. But this is only possible when you have huge payments or huge receipts, right? It's not for small payments because it has a standard size and you can only make this contract in this standard size only. Is it clear to everyone? Sami, clear? Then we have currency option. Okay, currency future, as we said, it's a contract. It's same like FRA. FRA is a contract, so currency future is also a contract. So that means you must have to close the contract, right? Currency future is a contract. You must have to close the contract before the expiry date. Otherwise, on expiry date, it will be automatically closed. Whatever gain and loss, it will be settled from your margin account. Okay. Currency option. Here we have option. Option means it's not a contract. It's a facility available to us. So again, the idea is exactly the same. So we buy the currency option from the forex market. Okay. Idea is same. These options are available in standardized contract. They have an expiry date ending on 31st March, 31st June, 31st September, and 31st December, right? The difference is at the settlement date, if we expect that currency rate move to the adverse side, we will exercise the option. Look, we have a choice. Here we have a choice. We don't have to close the option. We buy the currency option. We want to close it, we can close the option. If it's favorable for us, we close the option. If the option is not favorable for us, we will lapse the option. Lapse mean on 30, let's say we buy the June contract and we haven't availed this contract, this currency future. So on 31st of June, it will be lapse. It will be removed. There's no settlement, there's no gain, no loss. So the currency option is same like FRA, but here we can take the advantage of the favorable position. Like, okay, look, here we make a loss of 25,000. See, we make a loss of 25,000. But in case of loss, we don't need to exercise the option. We don't need to take opposite position. It's our choice we want to take the reverse position or not. So if we were expecting loss, we don't take opposite position. We will say we are not going to exercise the option. Okay. So that means we have a win-win situation. So what the benefit exchange will get here? The premium cost. Currency future has zero transaction cost. You can enter into currency future by paying no premium, nothing. But here in currency option, because look, if the interest, if the, sorry, not interest, if the exchange rate moves to the adverse side, you will exercise the option. Otherwise, you will not exercise the option. So exchange is not going to get any benefit at all. So in this case, exchange will say, okay, this is the initial premium cost you have to pay, which is not reversible at all. So when you go with the currency option, you have to pay this initial premium cost and nothing else. Okay, so let me explain you here. A company can decide, okay, so options are similar to forwards, but one key difference. They give the right, but not the obligation to buy or sell the currency. I mean, we have no responsibility to take the opposite position. If we wish, we can. If we wish, we cannot. Okay. So we can exercise or we can lapse. When we lapse, if spot rate is moved favorably, then why we lapse? Why we exercise? We lapse option. Okay. So again, but the downside is it, yeah, we have to pay the premium cost here. Okay. Now, one point here. So, in case of currency future, if you are going to receive money, what you will do? You will sell future. So, these points you need to understand. These points you need to learn. So, if you are receiving money, if you have a foreign receipt, what you will do? You will sell currency future. If you have a foreign currency payment, you will buy currency future. Similarly, in currency option, we have two types of option: call option and put option. Okay, call option is same like buying currency. So when you are buying currency, you are going to go with call. Call means right to buy. We are not going to buy, we have a right to buy. So when you are expecting the foreign currency payment, you will go with call option. In case of currency, you will go with buy currency. When you are receiving the foreign currency, you will go with put option and sell currency, sell foreign currency. So that's the idea you have to keep in mind. Okay. Okay, and let's do this question by the way we end the topic. Yeah, what is the answer here? The spot rate. Yeah. Rate today for exchanging one currency for another for immediate delivery. This is the definition of a spot rate exchange rate, 2-day exchange rate. Next. PPP theory. Concept that same goods should sell for the same price across countries after exchange rates are taken into account. Yes, that's a definition. The law of one price. That's the meaning of the purchasing power parity, the simple meaning. Next. Yeah, so using the interest rate parity you can find, right? So the rate of spot rate is given here, which is 19.68 Iraqi dinar over rupee, right? So dinar is on the top, keep in mind, dinar over rupee. So the formula is 1 plus I of the first currency, which is dinar. So the first currency dinar is in Iraq. So Iraqi rate of interest is 10%. Is that right? 1.10 divided by Indian interest rate is 1.15. So the answer is really dinar is sorry, 10% is rupee. Sorry, yeah. So 10% is rupee. So rupee is down and dinar up. So 15% for dinar. Yes. So the answer is B, right? B, huh? Okay. B is the answer. Next one. Yeah, a forward exchange contract is an immediate, fine, firm, and binding contract. Yes, for the purchase and sale of a specific quantity of at a state of a stated foreign currency. Yes. Is the rate of exchange fixed at the time of a contract is made? Yeah, you fix at the time of the contract. For performance in the future? Yes. So all of the above. And last question. So the idea of the money market is if you have foreign assets, you should have the equivalent foreign liability. I mean, if you have foreign receipts, right? So you should have a foreign liability as well. So borrow in foreign currency, so it will be a foreign liability. Money market hedge. So B is the answer, yes, and vice versa.